Good morning and welcome to today's webinar hosted by Spheria Asset Management. My name is Gerald Williston and I'm a Director of Distribution at Pinnacle Investment Management. Pinnacle are an equity partner and provide non-investment related services. This relationship is important in the current market as we provide a stable operating environment, freeing the investment team from unnecessary distractions and providing institutional support and infrastructure so Spheria can focus on investments and clients. Before I introduce the presenters, I would like to wish everyone well and hope you and your families are healthy and keeping safe. Let's get started. Today we are presenting Mathew Booker and Marcus Burns, founders and portfolio managers at Spheria with over 40 years experience in the industry. As a team, Spheria specialise in small and micro-cap companies and feel it is important to keep an open mind when looking at potential investments as facts change over time. Remember, you can submit questions as you go along and we will come to these at the end. Over to you, Matt and Marcus.
Thanks, Jed. It's Mathew, and welcome to the webinar. If you could just tab forward, thanks, Jed. So we just want to frame the presentation with this quote from Baron Rothschild, and basically we think it's very apt. Obviously, we're going through fairly uncertain times with COVID-19, and that's dislocating the market in many ways. But it's also presenting a phenomenal opportunity to buy and reinvest in a market where we're seeing some very interesting opportunities come up. Ones that will survive the downturn and provide investors with a very good opportunity in the short, probably in the medium term. So the great quote there is time to buy is when there's blood in the streets. And that's exactly the kind of situation we're seeing at the moment across small, mid and micro caps in Australia.
So we haven't seen this exact issue before. Obviously, we have been through the GFC, World Trade Center in the past, and obviously both were significant buying opportunities. People are comparing this to the depression, the Great Depression potentially, which obviously started with the stock market crash in 1929. We did want to point out the difference back then. There was a gold standard, so the money supply had to be backed by gold. These days, the central banks can print money, so they can print money to work their way out of these issues, and that does debase people holding cash over time. So we just wanted to point that out, that there is a factual difference between the situations that we're facing now and versus 1929.
Exactly. Thanks, Matt. And we also want to provide a quick update in terms of operations across Spheria. Many investors have asked us, how we're traveling through this, how we're dealing with remote working. All staff are currently working from home and working successfully. Our technology has been obviously implemented by Pinnacle, and it's running very efficiently. Fortunately, team morale remains high. We are running daily conference calls multiple times a day, often between different members of the staff, and having plenty of group calls to see what people are working on and maintain energy and enthusiasm for research. Critically, we're also dialing in multiple times a day across the team into many research calls that are being hosted and set up by Spheria and in some cases by the broking community, to give us access to management teams, to give us a good sense of how they're trading, how they're providing their own businesses and provisioning through the downturn, and it's giving us good opportunities and good ideas. And the research flow is continuing unabated through this period.
Next slide, Jed. This is the table just showing the deaths in Australia in 2017. And what we just wanted to point out is we just want to be objective, and we wanted to put things in context. And you can see that over 160,000 people died in 2017. Over 400 people die per day in Australia, young, old, some healthy, many unhealthy. So we just wanted to point that out and just put that in context. So far, I think the latest update is about 46 people have died from COVID in Australia, which is obviously very sad. And we know these figures are going to keep rising. Clearly, there's over 90 people in ICU. We do want to point out that Australia has a great healthcare system. We think the government has tackled this well in terms of flattening the curve, and they have definitely bought time to address the ventilator issue in terms of having more ventilators in ICU. So I think they're looking at quadrupling the number of ventilators in ICU. We also wanted to point out that the median age of deaths from COVID in Australia is 78. The average life expectancy for a person in Australia is just over 80. So it's not far different. There will be obviously young people affected. Obviously quite vulnerable groups will be affected, and clearly the elderly will be affected. We are concerned about the economic and social impact. And I think, the share market falls have reflected the containment measures that have been put in place across the globe. Obviously quite significant for the economy. There will be higher unemployment. We're seeing that anecdotally, and also at the queues, at the dole queues out there. And there will be a social impact. So on that note, we note that the government has, we believe, appeased the left with what they've done. But it is a central right government. This is a Liberal government, and there will be a focus on business and the economy. And we actually are taking a very optimistic approach, and we think the duration of this lockdown will be shorter than what consensus is. I think consensus is expecting a very long, drawn-out shutdown. We think that the government will move to transition the economy back to full online normal functioning sooner than people think. Overnight, we heard news out of Europe that Germany is transitioning the economy back, Denmark as well, and even Italy is looking at some of the containment measures and loosening as well. Obviously, China is back online in the most part as well. So we're starting to see some signs offshore that there is a transition back to the economy. Obviously, Sweden has gone down a different path and is looking towards herd immunity and protecting the elderly and the vulnerable. And we also think that that is a sensible strategy, although that has been derided by some parts of the political landscape. But we think this duration could be shorter, and that would be very, very bullish for the economy and for portfolios. And we think there's room for optimism, particularly if you follow the statistics and the inflection that you're seeing in offshore jurisdictions that have been very affected by COVID. And here you've seen a fairly benign outcome so far, thanks to fantastic government strategies. So far, things are looking a lot better than I think people and the media are perhaps giving. There's a lot of sensationalism going on at the moment. If we flicked...
Sorry, Matt, if I could add to that as well. Sorry, just to add one or two things there. The Australian government's balance sheet is in far better position than many foreign Western governments as well. So the $200 billion of stimulus that they've announced, give or take, adds a material amount of debt to the country, obviously. But we're coming from a much, much better place to start with than many Western European and clearly the US in terms of indebtedness. So I think the country will be in reasonably good shape coming through this. Likely to maintain its AAA grade credit rating as well. So I think the country trades well. And to Matt's point, there are many middle grounds to coming through this as well. The social distancing and other ways of containing the virus don't necessarily involve a complete shutdown of the economy. So there might be something that the government looks to gently liberalise, how the economy works and sort of feel its way through the crisis with COVID-19.
Just moving on to the US of A, because obviously that's where the greatest concern has been, because I think they were last in, so to speak. You can see the deaths in the US in 2017. There were nearly 3 million people died in the US in 2017. 56,000 people died of the flu and pneumonia. So, you're talking huge numbers. Now, White House medical experts forecast deaths from COVID to be about 100,000 to 240,000, even if the sweeping orders to stay home are followed. So we're talking about big numbers, but in context relative to the number of deaths per year and the effect of influenza on a yearly basis, these are not huge numbers. If we look at the Italian scenario, which has obviously been probably the worst countries affected, I think deaths are around 17 or 18,000 now. Perhaps they top out in the 20-something thousands. The US has over 5 times the population. So the numbers that America is talking about seem in line with what the Italian experience has been. So there is potential for a much better outcome. Now, if you look at the US, you're starting to see some signs of inflection on a logarithmic basis, and that looks positive. And the effect in some of the states has not been as bad. Florida, for example, it looks like it has been a less pronounced impact on Florida, and there is a higher percentage of elderly people in Florida. So it looks like New York has been the worst affected, but it looks like outside of New York, things could be a lot more positive than people think. So again, just wanted to put things in context. There's no reason to panic. Obviously it's a very frightening experience at the moment. It's affecting everyone. But I think that globally, the political agenda is to move the economies back online, and I think sooner than people think, which would be very positive for share markets.
And we thought we'd just frame some market observations over the last month. Clearly, end of February and into March has been a tough time right across the markets globally. Australia's had a pretty tough time as well, particularly in the smaller end. So the three graphs here just break down the sort of large, small and micro cap indices to give you some sense of how we've traded through that. And clearly the smaller companies have been hit the hardest. And really that's been driven by liquidity. So as people have sought to liquidate and protect their investments by going to cash in some cases, you've seen a pretty dramatic sell-off. And as companies have got smaller, I think the perception is that they're riskier. And so their shares have been sold off to a greater extent. In many cases, we'll come on to a chart later on showing where we see the greatest short-term impact from COVID-19. Those stocks have been hit pretty hard, particularly areas like retail, for example. And we'll give one particular example later on that we show where we think valuations are really, really attractive in some of these areas here. So growth has miraculously outperformed value going into this. But we feel that sort of more value-based opportunities will kind of come out of this and trade really well. So giving us two opportunities. One is to look through the portfolio, find interesting opportunities. Some of the growthier names have been sold off pretty hard as well. And so we're finding a combination of interesting growth names and good value stocks that we can pick up or rotate the portfolio into a little bit and give us a really good opportunity to bounce out of this with really good performance.
And what we've seen in past downturns, back in 2000, 2001 and the GFC was that value rallied hard out of these downturns. So they get completely depressed into them and pronouncedly and disproportionately affected, but the bounce out is quite significant. A lot of our companies are sitting on significant cash levels. They will be able to buy back stock. A lot of them are that cheap at the moment. We'll talk about Vita Group soon, where the free cash flow yields are that high that they can buy back significant amount of stock if the share prices stay depressed. So there's capital management activities that can take place to drive value across some of these companies. So we're actually quite positive. We think there could be a huge value rally out of this. As I said, it's happened twice before in our working careers. We think we're going to see it again.
Next slide. Thanks, Jed. This chart just gives you a quick summary of our thoughts and what we're seeing across the small cap spectrum in terms of which sector have been the most affected. And obviously some areas have seen a benefit. So with the closure of restaurants and some cafes, you've seen a real shift back to food retail, people purchasing their own food and cooking at home, etc. So things like consumer goods, food retail, seeing a material uplift in revenue. And that's likely to be sustained for the period of the lockdown, we feel. Telecommunications companies reporting a big increase in obviously people using data from home. And then obviously online retail and pharma are probably seeing a pick up as well as people shift the way they purchase and obviously stock up on pharma products. We think a more neutral outlook for things like healthcare and resources and utilities. They're not necessarily seeing a benefit or a decrement in terms of revenue short term. But the weaker side are clearly things like the property sector where there's rent abatements and rent deferrals being offered to tenants. The tourism, leisure and gaming sector clearly having a massive negative at the moment because large gatherings and groups and social activities have been curtailed. Offline retail equally going through a tough period. Infrastructure in some cases because especially things like airports where travel's been significantly reduced. You're seeing revenue obviously significantly reduced there. Now, obviously the question is how long the downturn lasts and also how the market restages the reopening of the economy. Obviously we feel that domestic travel is most likely to reopen first, and eventually the global travel, but that could be sometime down the track. And then lastly, financials are feeling an impact. In many cases, banks are being asked to cushion the economy to some extent. They're being fairly cooperative, I guess, with the government and the economy in general by allowing companies to push through stress tests and typical covenants and liquidity measures. But they will definitely absorb some of the shock, and you're seeing that in the form of reduced dividends and obviously bad debts, etc. So that's how we feel the economy is being dealt with a shift in demand at the moment. And we'll come on to explain how that is giving us some good opportunities with capital raisings in the next couple of slides.
Yeah, just on portfolio changes, and we have been rotating a bit. And what we've seen, I suppose, in the market is there is a bit of a flight to safety in March, and consumer staples, which obviously benefited from some of that buying, those buying trends or buying behaviours of consumers like Asaleo and Bega, we have been rotating out of. We just don't think it is the time to hide, which is quite ironic because we're all hiding at the moment. But we think it is time to get on the front foot. We have been adding into names where we think there is, good balance sheets and good turnaround potential in terms of their P&L. So obviously, some of the companies that we are buying now don't have a lot of revenue. I mean, Premier, for example, would obviously be highly affected by the store shutdowns. But we think, we think we're playing a bit of a gamble on the duration of this. And obviously, it has a great balance sheet to ride it out. And on the other side, we think there'll be a return to normal conditions. I think, you look at past cycles and everyone says we're going to learn something from the downturn, but invariably we don't. And we think it will be back to business at some point in the not too distant future. So there's good companies there, good balance sheets to ride out the downturn, but also, that will get leverage when things recover. And so we are on the front foot. We're not hiding. We are trying to rotate out of some of the stocks that have done well. And it's not a lot of stocks that have done well across the market. It has been indiscriminate selling, but there's definitely some good companies where valuations are just so depressed now and the balance sheets are strong that you can really play that upward thematic as the economy does recover, as the government moves forward with transitioning the economy back online. I think Marcus wants to talk about some of the capital raisings because it is a dynamic that is at play at the moment, and you can make a lot of capital, make a lot of money out of capital raisings at the moment. So we'll just go to the next slide, please.
Just hang on, Jed. One other thing I'd like to say is that we've always told investors that our style is neither value nor growth. So Matt and I both believe that stocks can represent both opportunities. No one's trying to buy an expensive company. We're trying to buy a stock at a discount to fair value, whether it be called growth or value. And we've frankly been struggling to find sort of growthier names in the last couple of years that have met our value criteria. In other words, they've just been too expensive. And what we're seeing with this dislocation is that some of the growthier names have been really sold off quite hard and actually come back into levels that we think are attractive. And it's giving us a good opportunity to rotate a portfolio, as Matt said, back in some of these names where we see really good long-term prospects for great growth, but the valuations are nowhere near as expensive as they were, and that's kind of exciting us, frankly. Next slide. So obviously, many of you will be familiar with the capital raisings that the market's been undertaking over the last 2 weeks. They've been pretty significant. And clearly boards are trying to prepare themselves and shore up balance sheets to trade through a protracted period of downturn. No one obviously knows with any clarity exactly how long the downturn is. And I think quite a few of the boards have really, really massively increased the amount of cash they need, probably more so than they really need, frankly, but they're just trying to make sure they're absolutely bulletproof to trade through what could be a short or medium or long-term downturn. Obviously, our view is that with the control on COVID, things are likely to be shorter term, but I think boards have reacted to shore up balance sheets. So the areas that we've been seeing that have been the most active have been tourism and leisure, the retail space, and clearly media. There's some notable examples of some small caps there that have raised capital, and we'll talk about a couple that we've partaken in. So, IELTS, the Auckland Airport, Media, Southern Cross, Kathmandu, Reese, Webjet, and Flight Centre obviously have been front of foot there, and there's been many others around that as well. But they're some of the larger ones that we've been looking at as a team. I guess the key thing we've been looking for is that other companies raising enough capital to shore up the balance sheets as opposed to just reduce current debt. We'd like a business to kind of have a level of balance sheet post the capital raise that gives them a long runway to survive a downturn. In some cases, we don't think they're raising enough, so we've issued a couple of those capital raisings. But in cases where we see really good quality businesses, a good discount, and a decent chunk of capital being raised, we found it quite attractive. So a few names we've bought into recently have been Auckland Airport, which the stock will go through in a bit. Reese, which we've known pretty well. We've owned previously in the past, and it got fairly expensive post the acquisition in the US. And then more recently, we've added IELTS, which is a high quality English language testing company as well. So yeah, we do see a really good risk reward opportunity for investors in many of these names, providing the capital they're raising is sufficient to see them through a potential downturn.
The other issue at play is that retail investors, they're seeing a shift of value to institutions, with the government and ASIC raising the cap on placements from 15% to 25%. Effectively, retail investors aren't allowed to play in those placements, and what you're seeing is huge dilution for retail investors. So the only way you can access these recapitalizations is through an institutional fund manager, and that's the benefit we have. We know it's not equitable to retail investors, but at this point in time, a lot of these companies are very distressed and they need the money quickly. And the only way to access that is through institutional managers. So there is a big shift going on here from retail investors to insto. And you have to be mindful of that retail punters just won't have access to these raisings in a proportional manner. So it is inequitable, but that's pretty much how it works.
And look, in many cases, part of that is driven by the fact that timing is of the essence, and they've got to raise money quickly to satisfy the board and the risk. So, but to Matt's point, it is actually giving institutional investors a really good opportunity. Just on the next slide, Jed.
And just one of the opportunities, we've spoken about Vita Group. We are a big shareholder in it. It is a reseller for Telstra, so it runs a lot of the regional and suburban Telstra shops. It does a great job at it. It sells a lot of its own product through those stores. What you've seen is the share price was absolutely pounded in March. So it had a fantastic result in February. The share price went up, and then it pretty much halved in March. Now, this company has $26 million of cash in the bank. That's net cash. The stores are actually still open. So the ICT, the Telstra stores are still open. They're seen as an essential service. So that the company would still be making money at the moment. Obviously, foot traffic will be down, but there is a lot of telco people changing packages, etc. So there is still business around. We think they're making money, and obviously, when COVID does pass, it will revert to more normal conditions, and the company should be firing when those normal conditions return. So we think that the market's got this one completely wrong. It's trading at just over 2.5 times EBIT. So, it's nearly a 50% free cash flow yield at the bottom. It is ridiculous given the balance sheet and the fact that the stores are open, and that we will come out of this at some point, and there's going to be a reopening. Foot traffic will come back eventually. So we're quite positive on it. We're flummoxed by the share price moves, but as we said before, it is a liquidation issue. Managers have just liquidated small caps and micro caps indiscriminately, and that's the opportunity set. So people buying now, the risk reward is heavily skewed in your favour. So we're very positive on this one.
Absolutely, and to Matt's point, most of those stores are still open today. So unlike many other retailers have shut down for a month or two, Vita Group is still trading through this because it's been deemed an essential service. Next slide, thanks. We touched on Auckland Airport before, just as a cap raise candidate. Look, a couple of things we find attractive about this asset. It's the largest airport in New Zealand, obviously. It's got a very, very large land bank surrounding the airport, which we think provides it a very attractive long-term asset to build upon and expand into. So a couple of points here. First of all, on the right-hand side, you can see that the cash flow conversion has been pretty solid over the last couple of years. Well, since 2001, up in the sort of mid 70% range. Obviously, the last couple of years, you've seen that EBIT accelerate, and they've been booking through the P&L some land revaluation there, which hasn't translated into cash. But as they develop industrial property around the site, they're seeing an uplift in valuation there, which they do book through. They're required to book through the P&L, which is added asset value, but hasn't actually added cash flow to the business. But underlying business is very high margin, very profitable. And clearly in a very decent growth trajectory through most cycles. So international travel is growing roughly twice the level of GDP in most countries. And it's the same case in New Zealand, growing around 6% per annum. Half of the business is regulated by the Commerce Commission in New Zealand, in conjunction with the airports and the negotiations between the airlines. So there is some level of regulation around the asset base. but the other half of the asset base is completely unregulated. It represents rents on retail and industrial property, which they're developing around the asset. They've raised $1.2 billion in placement. Net debt was close to $2 billion prior to this, so they've massively de-geared the balance sheet and given themselves a long runway, no pun intended, to trade through a significant downturn. But as we said before, our sort of central thesis is that domestic travel is opened up in these countries, including New Zealand, before international, which gives them domestic travel around about half of the volume through Auckland International Airport. Then Trans-Tasman's probably likely to open up, and then obviously global down the track, selectively with different countries as governments get comfortable with COVID-19 controls in every country. So, we think this business has really raised enough capital to trade through. It's an incredibly good long-term asset. And for the first time in a long time, we're finding an opportunity to get debt at a price that we think are attractive on a very long-term basis. Next slide.
Yeah, just on the outlook, and first I'll talk about performance. So performance in March was difficult. So the small cap fund was broadly in line with the index. Our opportunity strategy, which is a mid-cap strategy, so it goes into bigger companies, was also flat relative to the index. The micro-cap fund did underperform. We were down about 6% relative to the index. What we've seen in the last week or two is quite a significant rally across all the strategies, and you're starting to see an exhaustion of sellers, we think. And there is a lot of money on the sideline. Obviously, some of our peers have gone to 30, 40% cash. I think some of them have missed the bounce. And the question is, does that cash get redeployed back into the micro-cap, small-cap landscape? And that's a risk, especially with central banks obviously printing more money. It is marginalising cash. At the moment, it feels safe, but in the long term, it won't be. And that's been the key for many in many downturns, is that the central banks, proliferate the economy with cash, and that leads to asset inflation. And obviously, stock markets in the medium to long term benefit from that, rather than the economic impact, which we think is quite sizable at the moment. But we think at some point there will be a transition back, as I said. So anyway, we think we need to remain calm and objective. There will be some casualties, although at this point in time, you've seen a relaxation of insolvency rules in the country, and you're seeing the banks provide relief on covenants. So at this point in time, the companies are operating. Some are obviously operating at a loss. There are some subsidies coming through which will cushion the blow, and we think the government's done a great job in terms of bridging that economic chasm at the moment. So whilst there might be some casualties, there will also be some huge wins when we come out the other side, and we think the wins will far outweigh the losses. So it's good to have some diversification in your portfolio. Obviously, we are a small component generally of people's portfolios, but the returns in small cap and micro cap can be quite extensive coming out of these downturns. The panic selling has presented opportunities. We've seen rallies in the last week or two of over 100% in some of our stock names. So huge moves at the moment. There's definitely pockets of value at the growthier end of the market, as Marcus discussed before. So we are rotating to some of these names that have previously been way too expensive, but we actually think they're good businesses at fairer multiples now. We think the markets will invariably recover. Obviously, China's leading the way, which is quite ironic. As I said, Europe is starting to come back online. And the US, we think, will move to transition the economy back online in the next month or two as well. We do expect a number of large recaps. As we pointed out before, retail investors really get squeezed out, and that there's a value shift from retail to insto. We can take advantage of that. So we think we're in a good position at the moment. We think there could be significant returns from here. There's going to be volatility. This is not going to be a linear increase in the markets. You're seeing a little bit of a sell-off today. I'm not sure what's driving that. I suspect there are still outflows in industry funds where you've got members switching into cash. You've got the potential for drawdowns of super. And so you do have industry funds which are sitting on a lot of unlisted assets, having to sell equities and any liquid assets. And I think that has had a pronounced impact during March, and it could continue to have an impact this month as well. So there will be volatility, but you're starting to buy things where the risk reward is heavily skewed in your favour, particularly given the government's stimulus, the government and the bank's relief in terms of covenants. And, you know, we do think there will be a transition back to a normal working economy, hopefully sooner than we think. Marcus, did you have anything to add there?
Oh, no, I just also important to add there that, you know, we, as Matt said, we're excited by the opportunity, but also we're aware that the downturn could be protracted. We think it's unlikely to be too protracted, but in case it is, you know, our core thesis of buying good cash flow companies with strong balance sheets gives us some downside protection, we feel, if things remain tough for longer. But when things invariably recover, these stocks also re-rate. And so we are, you know, we feel frankly quite excited by the opportunities we're seeing in front of us right now. And as I said, the team's working well, the business is well capitalized. We're backed by a great partner with Pinnacle, and so we feel we're in a great position to you know, to trade through this and invest well for our clients. And then lastly, this is just the top 10 holdings across the small caps and the micro cap fund. And we'll open up to questions now. Thanks, Jed.
No worries. Thank you, Matt and Marcus. One of the first questions that's coming through is, how do you expect the small and micro cap index to perform compared to the larger cap index going forward?
Well, I think the larger cap index is saddled with obviously quite exposed to the banks, and you know, bad debts could be rearing their head at some point. Obviously, there's a lot of unemployment in the system. You know, there could be some corporates that fall over, but at this point, like I said, there's been some relief provided on that front. So it is a question of how the banks perform in that large cap index. However, if you look back historically, you tend to get more outperformance out of micro cap and small cap from these downturns. Obviously, you get a more pronounced impact on the way down, but you get, you know, the corollary is on the way back up, you tend to make a lot more money. So we are seeing some of the institutions actually shift money into small and micros at the moment. So we've benefited from that in some of our mandates. We are getting interest from other clients as well, like other institutional clients that are looking to put money to work in the small and micro cap space. A lot of the older hands out there know that the returns could be quite significant from here. Where we have seen redemption activity during the month was retail. So retail, there was some redemption activity, but that has slowed. But yeah, we're starting to see some of the institutions look to take advantage of this downturn, and we've seen it in our flows, and we think we'll see more of it over the next month or two.
Another one's just coming through is just in terms of cash levels in your funds as opposed to now, how have they, as you've been buying new stocks, have that come down or you've kept a level in there?
Yeah, cash levels have come down. So we weren't holding a lot of cash in the first place. We don't believe we're here to make a call on cash versus equities. We're here to invest in the share market. But yeah, we have in recent times, because we've been investing in some of these capital raisings, we have seen the cash levels come down in our portfolios pretty much across the board. Marcus, did you want to say something on that?
It's a fair question. The other point to raise is obviously, as we did flag in that chart, in that slide earlier on, we've been selling a few positions that have held up well or actually risen a bit into this and to sort of recycle the cash flow back in some of the placements and fresh ideas. So yeah, cash levels have dropped a little bit, but there's been a fair bit of recycling as well into fresh ideas, which we're finding. So it's a bit of both. But yeah, fundamentally, we think we need to be invested, and that's what we're trying to do for clients.
Just a question on the holding that has previously been discussed, Essentia. They're asking, with this much smaller market cap companies that have been leveraged and they've had good cash flow generation, but they've been impacted by aggressive competitor pricing. What's your thoughts on these companies being profitable going forward?
Yeah, look, Essentia is an interesting one because we spoke to the company last week or the week before, and they're actually seeing positive trends in the business. Obviously, they're very exposed to government at you know, a high level, a senior level, and local government level, and the drawdown on research and just information in terms of media monitoring from those clients has been significant. So they're actually been a benefactor recently, and you wouldn't believe that if you looked at the share price. The other dynamic at play there, and it is a very small position for us now, the other dynamic at play is their competitors there's some conjecture out there as to whether they make money. Well, one of their competitors doesn't make money, one of the smaller players here, which has been taking share. And the question is, how long will that be funded for? And then the bigger global player, which is Meltwater, there's questions about its cash flow as well. So some of these competitors could drop away, which would be an improvement in the competitive landscape. But at the moment, Icentia is benefiting. Their client base is strong. A big chunk of it is government, so they're going to get paid. The cash flow is good. The debt balance has fallen considerably under new management. So you're seeing potentially positive trends there. But again, the share price, it is a microcap. No one cares about it. It has been debased in the market, but there could be some positive dynamics at play there.
Just one back on COVID-19. Restrictions, why do you believe the restrictions will come off sooner than expected, given Japan only yesterday declared a state of emergency?
Yeah, look, we're seeing, as I've said, Europe, and overnight, this is fresh news that Europe is lowering their restrictions. Germany and Denmark have moved that way. It seems like Italy has moved that way. You're seeing an inflection, both on a straight basis, but also on a logarithmic basis. You're seeing inflection in terms of case growth. We think those companies that have led the way in are showing the way out. And obviously Australia has quite a benign outcome. Japan didn't test a lot, so they've increased testing levels. They're finding that there is more virus infections than they first expected. Their hospital system perhaps is not as up to scratch as some of the other markets. Obviously Australia has bought time and, as I said, has put more ventilators in. Japan seems to be a bit behind in terms of having capacity to meet obviously the demand and the increased testing levels. So look, Japan, it is just Osaka and Tokyo, and those are big headlines. If you actually read the context around them, people are still free to move. They're just recommending against group meetings, etc. So you need to read quite granular on that activity in Japan. Like I said, it is more about the hospital system than about the actual infection rate.
Clearly, cases will be, the countries will have different experiences depending upon the way the governments and their citizens have reacted, I think. So, we can't read into one country what will happen exactly somewhere else. We can only look at what we're seeing ahead of us and look at what the government's, the messages and sounds the government's making around opening up the economy and how, what their attitude to it is. So, we're very cautious about looking at one or two examples and saying it'll be like that, either positively or negatively, but just trying to feel our way forward as clearly the government is here as well.
And that's the thing. Everyone portrayed Italy as a potential outcome for Australia. Clearly, we are not going down that path. So let's, instead of taking an outlier like Italy, perhaps look at other countries that have travelled well through this and apply it to Australia's case. I think that is the more likely outcome in terms of looking at the numbers, trying to be objective rather than looking at headlines. I think people are just focused on sensationalism at the moment and not looking objectively at this COVID crisis. It's not as bad as would be suggested.
Okay, we've probably got time for two more questions, as I just want to be conscious of everyone's time. Please bear in mind, though, that questions that have come through, we will answer and get back to you following this webinar with the webinar slides and presentation. Just quickly, the investment case for Ausforex and Mortgage Choice, if we can run through them quickly.
Sure, I'll handle Ausforex. I mean, Ausforex is a trading platform for largely foreign exchange, clearly, as the name suggests. And the reason we like that stock is a couple of things. It fits our key criteria. Really good cash flow generating business, obviously, and a really good history of doing that. Balance sheets net cash. It's well run. There's a new CEO management team came in about 18 months ago, 2 years ago, and done a really good job improving systems, getting the sales force more incentivized, etc. So that's the background. Valuations now down levels we think is attractive, and bizarrely it's trading very well through this period. So as volatility with both currencies and equities, etc., expands, they find more people trade currencies. And that widening spread between bid and offer has actually cost some of their competitors their relative positions. So some of the cheaper alternatives haven't been able to handle the volumes that Ausforex can do because it's got a better banking system and it's more of an industrial grade network. So they've actually picked up a lot of market share in this period, vis-a-vis many of their competitors have come through and tried to undercut them on price, but don't have the facilities to facilitate the kind of volumes and quantity of foreign exchange that clients want right now. So they're trading really well, and the valuation's attractive, and we think they'll probably trade this pretty well, actually. So that's the thesis there. And Mortgage Choice.
Yeah, on Mortgage Choice, I think there's some misconception out there that this business has warehousing and writes mortgages. It is a pure franchisee business, a franchisor. It takes a clip of all the revenue going through its franchisees. It's an annuity stream type business. There's a $55 billion loan book. Unless you think we're going into a depression and that loan book evaporates, this company is going to come out the other side basically printing money. The valuation is severely depressed now. Obviously, it's a microcap. The market has basically shot first and is asking questions later. If there is a recovery, and we believe there will be a recovery back to more normal economic levels, you know, I think 6 out of 10 mortgages are written by brokers. Mortgage Choice is one of the leading independent brokers in the market. It will get its fair share of volume. You know, this is a fantastic business. It doesn't have any debt. It's got net cash. It generates good cash flow. There will be a rebound once the economy comes back online. These companies, everyone's focused on the share prices. They're not looking at the underlying strength of these businesses. It is completely ridiculous where it is trading at the moment. These things are being given away. If it makes $10 million of profit this year, it's on 7 times profit, 7 times PE. It could make more than that given the strength of its loan book. So, look, you know, these are the kind of opportunities that are popping up. If you focus on share prices and volatility, you won't survive in this market. You need to focus on the medium to long term and look at fundamental value. Otherwise, you're going to get squeezed out. And I think a lot of marginal investors got squeezed out in March. We think the road ahead looks much better from these levels. A lot of the passive and quant money, which followed momentum, is going to struggle. We think active management will find its way forward in this sort of market, because active managers look at valuations. They just don't focus on share prices going up or down. And valuation is going to be critical going forward to anything, to making money. Anyone who thinks otherwise probably got found out in March, will probably get found out going forward. That's my view.
And one final question before we head off. At what point within the small market cap space does the liquidity issue become an insolvency issue and rather see a U-shaped recovery other than a V-shaped recovery?
Well, so far we've seen a little bit of a V-shaped recovery. People might call it a W, but at the moment we're starting to see, we've definitely seen a V-shaped recovery. Like I've seen, some of our share prices have doubled from the bottom. Obviously it was a deep bottom. Look, in terms of economic recovery, everyone's going to have a different view. There's plenty of people that will dwell on negatives. There's pessimists and optimists out there. We try to be optimistic, particularly when everyone is being pessimistic. And, you know, we believe that, as we've said, that the Liberal government will look to transition the economy back. They've appeased the left. They are central right in nature. They will be pro-business. They built a bridge in terms of funding across this chasm. And we think the chasm will not be as wide as you think. So we're playing the optimists. You know, everyone was optimistic going into this. For the last X years, we were pessimistic. We think there's reasons to be very optimistic given valuations, and given we've got a fantastic government, a fantastic health system, a fantastic country and population that have come together and obviously got on the front foot and have fought well. And you look at that in terms of flattening the curve. So let's be positive rather than negative, and that's the attitude we're taking.
I think if I can also add, the liquidity issue we're talking about is just simply liquidity in the shares, like the actual trading volumes, rather than liquidity in terms of raising capital through banks or other means. So far, this has been a very different crisis to the GFC. Obviously, that was a liquidity crisis driven by lack of trust between and intra-banks due to the spread of subprime, obviously across from the US outside into international markets. And central banks have been incredibly active on this, into this crisis to provide liquidity so that I don't think liquidity is going to be the issue. Rates are almost zero around the world. And as you know, as Matt and I said before, we invest in companies that can generally make good cash flow through the cycle. Clearly, the cycle's a bit different because it's impacted certain pockets more deeply than others, but strong balance sheets and some very aggressive mitigating strategies by the government, we think will help many of these companies trade through a downturn, frankly. So I don't think you can necessarily argue the liquidity, meaning lack of share trade, will translate into insolvency. Matt, do you agree with that?
No, we're confusing. Yeah, definitely confusing liquidity in the share market to liquidity in the companies. And liquidity in the companies is good. Even the retailers have got rent relief, obviously coming their way. They've got the JobKeeper allowance as well. So they're going to be able to operate. To be frank, the losers out of this will be the ones that will be the landlords, seemingly. And everyone saw property trusts, I suppose, as defensive. But, it looks like they're going to get penalised because they're not a big employer. The government's out to protect jobs and retailers employ a lot of people. Unfortunately, property companies don't employ a lot of people. So it hasn't played out as you would think, because you'd see property trusts as defensive, but that hasn't played out. It's been where the jobs are that is more defensive. Which is an interesting dynamic. No one could have predicted that outcome. But obviously, the government can change dynamics quite quickly depending on where it directs its funding towards.
Perfect. Thank you, Matt and Marcus. Just quickly before we finalise here, I just want to remind everyone the team across funds are highly recommended by independent research houses, showing their conviction and belief in the team through market cycles. If you feel free to reach out to a member of the Pinnacle distribution team, numbers are there, contact number and email. We will send around the presentation and recording of this webinar afterwards. And just as a matter of business at the end, just running through ratings disclaimers. But without further ado, thank you, Matt and Marcus, and thank you everyone on the line. We appreciate your time today, support of Spheria, and we hope you and your families stay healthy, safe, and keep well. Thank you very much.
Yeah, thanks, Jed, and thanks to everyone for the support. We do think that this is a money-making opportunity, but it is very frightening for all of us, and hopefully everyone stays well. Thank you.
Thanks very much, everyone. Appreciate your time.